Now it'll start recording, maybe. Okay. Better check. Every time I try to rush. That's still. Okay. So you guys know what a balance sheet looks like. These are a lot more complex. So what are you going to use a balance sheet for? You know what? The income statement is really good for predicting future cash flows. So balance sheet can focus. What do they suggest? Evaluating what? Financial position, statement of financial position, that's good. But what does that mean? What does my position do for me? How, what I am. Risky, like, yeah, risk, yeah, risk in business. Absolutely. So when you look at liquidity, are we going to run out of cash? Right? Our current ratio might be good for that. Working capital might be good for that. Current assets plus current liabilities. Am I good? Okay. So, yeah, liquidity. Okay, am I going to run out of cash? That's important not to, obviously. Solvency. That's going to pay your debt. Can I pay my debts? Which is a little bit different thing, right? That's more of the long-term stuff. It's a current, too, of course. We have enough cash to pay my current debts. But we usually consider that liquidity more, right? But with solvency, am I earning enough profits on an ongoing basis to pay off the long-term debt? Make sense? Okay, so you can break it down to things as simple as that. And then financial flexibility, what do you mean by that? Can I do things? Can I borrow more money? Can I issue stock? You know, are people going to want to buy my stock? How much return do I have to provide people, given the riskiness of my stock? The riskiness of my stock is partly based upon fluctuations of earnings, right, up and down, and also based on debt-to-equity relationship, right? You take on a lot of debt, you're more risky. Who would you rather loan money to? Somebody with low debt or somebody with high? Low, of course, right? Okay. Who would you rather, so you give a better interest rate maybe, right? Better terms. Who would you rather invest in? Somebody with low debt, right? And relatively high equity. Because you're taking on less risk yourself, okay? So we try to balance these things, you try to manage these things. So, what's the limitations? Whole bunch. It looks just like the income statement, doesn't it? Judgments and estimates, lots of estimates. Bad debt expenses and estimates, just like the allowance. Whoops, bad debt expenses and estimate. The income statement, the allowance is an estimate too, right? On the balance sheet. Net realizable receivables is an estimate. Accounts receivable less the allowance. Your liability for warranty repairs. Big estimate. Warranty expense in the income statement. So you can answer sort of the same, can't you? And then the warranty liability on the balance sheet. You got the idea here? Okay, so lots and lots of estimates. So your income is really driven by estimates. Inventory is an estimate. Work in process is an estimate, right? Inventory. Finished goods is an estimate. Raw materials is typically not an estimate. But you're building up the cost of your inventory, right? It's your raw materials plus your labor plus your allocation of overhead to it. Application of overhead, right, guys? It's an estimate. Which means what's an estimate? If inventory is an estimate, what kind of income statement is an estimate? Balance sheet inventory. Cost goods sold. Yeah, got it. Absolutely. That's it, guys. When you decide to write down inventory, it's an estimate to do that. How much should I write it down? Got the idea here, you guys? All kinds of estimates. Okay. So try to convert these, as you're reading them, try to convert them to something meaningful for you, where you give an example. Okay? If you give an example, you probably know what it means. If you can't give an example, maybe you're just memorizing terms. Don't do that. Okay, anyway, historical cost, what about that? Historical cost versus fair value or market value. There are different measures of fair value. One of them is market value. One might be replacement cost. I can give it market value maybe, right? But anyway, one might be discounted present value of future cash flows is going to generate market value, right? So there's market or fair value. Okay, so there's different methods. Anyway, so what do I mean by historical cost? We keep things at historical cost because we do not know what. Why do we keep laying at historical cost? It's been in our books for 100 years.
We haven't tried to sell it.
We haven't tried to sell it. We don't know its market value. That's the idea, but it's kind of silly even after 100 years. But you know what you can do in the notice of the financial statements? You can tell people what its fair value is. Based on what? Right, it's appraisals. Right? You try to make the best estimate you can. But would you ever want to adjust to fair value from historical cost? Not ordinarily, right? But what if you're an investment company? Now you do. So there are people who would account for them at fair value instead of historical cost, right? If I'm holding those assets to sell, I might want to tell people what the values are, that sort of thing. Okay, got the idea? But typically, what do we do with assets? Keep it at historical cost, even worse. Equipment and building, what do we do? We keep them at historical cost and then depreciate them and show them at net book value, which is what? The historical cost, the cost of the asset, less the accumulated depreciation. Does that necessarily reflect market value? No. But are you going to sell those assets? No. So what really matters is how much of the assets left for people to use, generating future revenues, and therefore future cash flows, right? So is it okay to show people the historical cost and the accumulated depreciation? I think so. You can judge how old the asset is. What if there's very little accumulated depreciation and a lot of dollar amount historical cost in equipment or building, and very little accumulated depreciation? What does that tell you? They're new. What if accumulated depreciation is almost as big as the asset itself, so the net book value is almost nothing? It's old. It's going to have to be replaced. There's some value to that, okay? And then, of course, we disclose a whole bunch of things in the notes of the statement. So, okay. So, a classified statement. Oh, and then we omit things of value, of course. What do you think for somebody like Google? Somebody like Microsoft. What is their biggest asset? Their employees, absolutely. Intellectual capital. So, where's that about?
What about their technology?
What's that?
I mean, what about their technology?
Their technology is their big one. It's their ideas, their knowledge. Now, they might have some patents and some things, although patents don't last any period of time in that business. You usually don't bother to patent anything long, because you replace it yourself before the patent would run out, right? And somebody else is going to be replacing it too with something that's better, and your patent wouldn't apply. But we still try to patent things, but it doesn't necessarily make much difference. So our patents aren't really very valuable. It's our intellectual capital that's, right? We've already designed what we are designing. Our ideas, right? So when we say human capital, we mean what human beings can do for you. What makes a restaurant really valuable?
So,
Usually their chef. How good the food is, how good the service is, right? Ambiance those people create. It's not really tables and chairs. No, it's not really. Right? Oh, well, you don't like that about you, do you? But the business is still worth a lot more. What do we call all that stuff? Generically, an intangible asset named. If I sell the business, what I'm going to record it as when I buy it. Somebody buys it from me, and they pay more than the fair value of all the assets, less the fair value of the liabilities. What's that?
Goodwill.
It's goodwill. That's where we plug it off. Right? You don't own people. Right? You don't own ideas, really. They're ideas that they're currently developing. But that's what's of value, of course, is why you have it. So in more and more businesses, intellectual capital is a big thing. And so when they talk about what's not there, well, all kinds of stuff. How about your customer relationships? It's not there. How about your vendor relationships? How about your government relationships? Some companies are fighting with the local government. Other companies have great relationships. Is there value in the great relationship? Oh, yeah. Big time. Is it the right thing for humanity to support all the things you do? Of course it is. It's the right thing to do. Is it good for humanity's profitability too? Of course it is. Win-win. Right? They want their name all over everything. Humanity doesn't really sell things directly to people very often. They do, but mostly what do? They sell to businesses. Right? I have humanity insurance coverage. I didn't pick it. Development did. Right? So advertising is kind of a silly thing. But then it kind of is. That's not the way they sell. Right? A whole bunch of companies provide all sorts of funding for societies, for charitable organizations, right? For governmental entities that we've never heard of. Because they're businesses that only sell to other businesses, so raw materials manufacturers, chemical companies, stuff like that. Right? We don't know who they are. We use all their products, but they're Procter & Gamble products or something, right? Okay, and that's fine. It's all right. Or they're, when you go to the gas station, you get some of this product, you don't know who you get. Okay. All right, unless it has the local name on it, but any other stuff is included there. Okay, so it omits a whole bunch of stuff. You know what an asset liability equity is. I can ask these, right, guys? Everybody knows on this quiz, fair game to ask for any for the balance sheet income statement, right? All the terminology, okay? All right, what's current versus non-current? It's arbitrary, it's classification. Current is what? The asset is going to be used up within a year or converted to cash within a year, or it's already cash. The liability can be paid within a year. That's it, it's current. What if it's more than a year, 1 day more? So you mean 364 days is current, 365 is not current? No, 365 is current, 366 is not current? Years, days of the year. Okay, anyway, right? What do you think? Yes, that's the answer. Only that's not the full answer. What else did you read?
Operating cycle.
An operating cycle, what could that be?
How long it takes for the projects normally.
Yeah, so like construction. Could be this way, building bridges. What if it takes me a couple of years to finish the project? I've had clients that were like this. I had a client that was building buildings, putting them on barges, waiting until the snow melted, and hauling them from Tacoma, the tide flats in Tacoma, Commencement Bay, Park South, right? They go up through Puget Sound, and then they go along the west coast of the United States and Canada, and take them to Alaska, and take them up where they were drilling for oil, way up in the northern part of Alaska. They only had a window of about a month a year that they could move, right? They could get them up there. So they built everything for the year, and they took them up there. What would happen if the ice didn't melt? Now there is no ice. Never mind. Anyway, this is a while back, right? It gets closed up every year, and only open up for about a month. Now it's open for about 6 months, you guys. Very the top. But anyway, yeah. Right, so it's easier to go back and forth now, okay? That's one good thing about global warming, I guess. Okay, but anyway, what's the deal with that? If we couldn't sell them for a year, couldn't deliver them, they didn't have any sell yet, right? So their operating cycle was how long it took to what? Produce the product, deliver the product, get paid for it. That's an operating cycle, right? And start over. Okay? So it's a year or an operating cycle, whichever is longer. Yeah, not shorter, longer. Imagine if McDonald's gets shorter. Their operating cycle is continuous, right? Every few minutes. True. Producing something and selling it and getting the cash. You guys are excited by that. Okay. So you know those things. So know what they are. That's the big thing. Read about what they are. They show some examples of descriptions, I guess, that you could have in the notes, or you could have them on the face of the statement. Any of these boxes, be sure to read them. You know, there's cash and then there's restricted cash. Now, restricted cash would probably be in what? Non-current. What does restricted mean? I can't use the cash. Oh, I'm right now in 218. Okay, so Altera Healthcare shows cash and restricted cash right next to each other, but I guess the restricted cash is stuff that's what? Still current, but it's restricted for something. See that? And then you go to, that's illustration 5.3. You go to 5.4, what happens? Owens Corning has cash and cash equivalents, and then cash and other assets, right? Restricted securities. So they have the current portion and the non-current. You got this, the idea here? Okay? So, all right. Oh, you guys know the difference between held to maturity, trading, and available for sale? By the way, is held to maturity a short-term investment? So there are short-term investments on page 218. Is that correct? Yes, it what? Held to maturity is a bond, investment in a bond, held to maturity, remember that stuff? Right? We amortize discounted premium, right? Held to maturity bond. How can it be a current asset? It's going to do what? You're holding it to maturity, but maturity is going to be when? Within a year, or operating cycle. That's what that would mean. Otherwise, it's not held to maturity. What would the bond be otherwise? Either a trading security, or available for sale short-term, or available for sale long-term. How do you determine what's, and what would stocks always be? Trading security, available for sale short-term, available for sale long-term. Okay, what makes us decide if something's a trading security, or available for sale short-term, or available for sale long-term? What are they? And all these are going to be at market value. You know why they're going to be at market value? Because we know what the market value is, because they're traded. Right? You can look it up. Wall Street Journal or something, right? Or Yahoo Finance or something. So you know what they were trading for at the end of the year. Unless they're not trading, and then you try to estimate the value, okay, which is kind of tough. And they talk about ways of doing that. So, what is the difference between trading security, available for sale, short-term, available for sale, long-term? We're going to have them all recorded at market value. Which means we're going to have to record the gains and losses for the change in market value on we continue holding. What's the difference?
Few weeks.
Okay, this is a day up to a few weeks. Judgment call, right? But very short term, few weeks. What do you do with the gains and losses? Put them on the. We think they're going to happen because we're not going to get rid of it before it changes much. So because it has a gain, increase in value, increase the debit the asset trading securities, right? Credit what? Unrealized gain on trading securities, or if it's a loss, debit unrealized loss on trading securities. And where does that gain or loss go, seeing as it's going to happen, we think? Because it's very short term. That's going to hit the income statement. You guys don't remember this, do you? That goes to the income statement, okay? Few weeks an income statement. How about both of these? Where does the gain or loss go? On the balance sheet called what? We talked about it last time. We have this third equity category called other comprehensive income. Yeah, comprehensive income. That's a comprehensive income item on the balance sheet. Cumulative change of other comprehensive income, right? Accumulated other comprehensive income. Okay, yeah, all right. And so then what's the difference between, that's a T, short term and long term? Oh, 2 to 5. We just defined short term. You're on a rough day. I was picking on him already. Yeah, when you're in operating cycle, right? It's short term. It's current. So if you're going to sell it within a year in operating cycle, what is it? It's a current asset. What if you're going to hold it longer? It's a long-term asset. You go under investments long-term versus investment short-term. Now here's the deal. Is that a judgment call on how long you're going to hold it? Yes. When I was working as an auditor, I had people, nobody wanted their assets to be trading securities, right? Why didn't they want their assets to be trading securities? Because they had to show the gain or loss on their income statement. So they just say they were going to hold it for more than a few weeks. Oh well, they didn't fight on that one. Unless you see they're trading them constantly, then notice as an auditor to say, wait a minute, those are trading securities. Recording the call, right? But, you know, it's a judgment call. Okay, what about the short term versus the long term? What if they hold it year after year after year after year? They want to call it short term to make their current ratio better. How does it make your current ratio better to have a short term? It's a current asset. It makes your current assets more without having any current liabilities. It would hurt your current ratio if you make them a non-current asset, wouldn't it? Right? Yeah. So they want them to be current assets, but they never sell them year after year after year. What do you think? They're not a current asset. Give me a break. You got to reclassify them non-current. Okay. Anyway. So, this stuff is serious, okay? Yes. All right, so they get some examples of those. That's nice. Talk about debt. There's a lot in here. How about inventories? How are inventories valued? So if you were asking a question, trading securities, available for sale securities are recorded out. Fair market value. Held to maturity. Historical cost. Discounted, right? Discount or premium amortized, not discount. Discount or premium amortized, right? It's the amortized historical cost. That's what it is. Okay. All right. What would you say for inventory? Lower cost of market. Absolutely. Okay. And we'll do that when we get the inventory chapter, right? 3 different ways of coming up with an estimate of market. Different estimates, huh? Lower cost of market. We're conservative, so lower cost of market, right? Not higher. Okay. Lower cost of market. You only write it down if market's less than cost. Otherwise, leave it at cost. Historical cost. So it's historical cost or market, whichever is lower. You know that. Okay, what else? Other pieces. You have to disclose this what? LIFO. Average. And if it's average approximates either FIFO or LIFO. So lower cost or market, FIFO. Lower cost or market, LIFO. Right? You want to disclose that. That's how it's done. Okay? You can see some examples of that on page 220. Right? Showing inventories. And then we separate the inventories by category. What is it? Raw materials, work in process, finished goods, wouldn't we? Okay. So you just look through this and think, well, what are we doing here? Okay. And they show some prepaids as another typical current asset. By the way, what order do you put the current assets and current liabilities? In the order of liquidity, typically, right? Cash comes first because it's cash. Closest to cash is cash. What's next? Accounts receivable, it will become cash soon. Then what? Inventory, because the inventory will convert into accounts receivable first when you sell it, and then cash, so it's further away. And then we put the prepaid usually last on the current assets because they're immaterial, usually they're pretty small, typically. And they're going to be used at different times, so we don't necessarily know. What would you do in the liability side? How current is it? Short-term notes payable, if they're more current than the accounts payable, you put them first. The accounts payable are more current, going to be paid more currently, you put them first. Got the idea? Accrued liabilities come later, usually, again, materiality issues probably. Okay, so we try to stick to that a little bit. We put them in the order of liquidity.
Okay, we show you some examples for different companies of that. That's just fine. In non-current assets, we could have long-term long-term investments, right? So long-term investments would include what? Investments in other companies, which might be what? They might be held at what value? Investments in other companies. Well, obviously, they can be at what? Fair market value if they're trading securities or if they're sales securities, right? Yeah, that's investments in other companies. Okay? But trading and available, so short-term would be in current assets. Under the non-current here, we have what? The long-term ones. Right? Okay. Long-term available stuff. How about held to maturity? Where would they typically be? Maturity is not within a year. Where is it going to be? In a year, right? In the non-current liabilities. Everybody got it? This makes sense, doesn't it? Just let it make sense. What is the thing? Right? What is it? Where does it go? Okay? What's this? And those would be at fair value, right? Available for sale securities? Fair value. Okay? Held to maturity, we already said that, right? Okay? The amortized values. Okay. How about investments in other companies where I own a significant share, but not a controlling interest? I own, say, between 20 and 50% of this. What do you call those? No, that's over 50%. And then what would you do if it's over 50%? I consolidate, I combine the two companies. Now I don't even show that other company. I consolidate and I have a minority interest, right guys? I combine their assets with my assets, eliminate any intercompany assets, right? If I have a payable receivable between my two companies, right? Or 100 companies sometimes, right? Companies own a lot of other companies. Okay, when you put them together, major corporation, all their intercompany assets and liabilities have disappeared. Where they owe each other, right? Also where they've done business with each other, they sold inventory to themselves at a profit, we have to revalue that. This is a big job. We do this in 414. There we talk about how to do an accounting in 414. So yeah, we do that. We put all their liabilities together, unless they're intercompany, of course. We eliminate the equity of the subsidiary, right? And then we might have a minority interest. And then we might revalue some of the subsidiary's assets. Remember that elimination entry we did in 101? Okay? Then what? I don't know if Jack does that or not, right? Okay? Then what? It doesn't matter. We'll get it later. Okay, then what? Revenues and expenses, we might put the income statement. But we eliminate all the intercompany. Then we have minority interest. Okay, anyway. What, though, if it's 20 to 50%? That was my question. You got the wrong answer. You're 3 times today. Okay, what's that? Yes, investment in affiliate. What method do we use there? Equity method. Remember that? Equity method. So we're using the equity method. The change, our share of the income gets added to the investment, right? And our share of their loss is deducted from the investment, and our share of their dividends comes out of the investment too, right? Okay. If you don't know this stuff yet, you will later as we go, okay? But read through this and think about it, okay? Right? You haven't had principles real recently, and maybe you didn't have it for me, because I cover a few things I guess other people don't.
Not well, but we cover them.
True.
Okay.
All right, anyway,
Property, plant, and equipment. How are they valued? Typically at historical cost, right guys? Less what? Accumulated depreciation. So it's going to be at depreciated historical cost. Aren't you? That's what it's going to say. Okay?
So, Keith,
What it is.
isn't that misleading?
To leave it at historical cost?
Yeah.
No, because we don't really know what their fair market values are. Otherwise, we'd change the fair market value if we knew. How can we possibly find the fair market value? You know what? I can do this. I can do it, you guys.
Yeah.
Watch this.
Estimated market.
It's not deceptive. We say they're at historical cost. It's what we paid for it. Might be 20 years ago, but it's what we paid for it. Okay? But look at this. I can do this, you guys. I figured this out all by myself. I can tell you what the fair market value is of your assets. Silly we don't use the fair market value. Right? Here's what I can do.
I can take the share price here, what the stock's selling for, times outstanding shares, the number of outstanding shares, and you know what that's going to give me? It's something called market cap, market capitalization. You know what? You did this in executive MBA, didn't you? You did 703. Didn't we do that in there? Well, no, that was in the finance class. We did it later. I did it a little bit, maybe. Okay, market cap. What's market cap? Market capitalization. It's how much the stock's selling for. I know the fair market value of the equity at any point in time. Doesn't do me much good to know that. It's just the number of shares times the number of shares times the market price at the end of the year. So we know that. Can we put that on the balance sheet if we wanted? Sure, nothing to it. What value is that at? None. I don't care what the fair market value is now. What do I want to guess? What's going to be later? We're predicting the future here, right? That's what we're doing. We're trying to predict the future. Future cash flows equates to future value. Make sense? Okay. If you get run by a truck when you leave here, your family's going to sue for what? Discounted present value of all the money you're ever going to make for the rest of your life. They're going to estimate high. You're going to be a billionaire in their views. What's the insurance company going to say? He was going to flunk out of school and never make a dime. We think he was using drugs, right? You know, so whatever. Got it? And if you are using drugs, they'll get a real low value. They can prove it. If you're not and you're a stellar student, which of course you are, right? It's going to be a big price tag, right? I have no idea. No. Okay, anyway, so what I think. All right, anyway, what's the deal here? Liabilities, I can get those too. Tell me what a bond's worth. It's selling in the market. I can get the fair market value of bonds. I don't know why we don't adjust the bonds to their fair market value. We know what they are. We just say it's immaterial. We shouldn't, should we? I disagree with Gap on that. So I'm with you on that one. I think this one should be valued at their fair market value. Or we could get the discounted present value of all those future cash flows. What if interest rates change? You guys know how to calculate the value of a bond? You do, right? We did it in principles. Could we value all the bonds? Of course we could, whether they're publicly traded or not. If they're publicly traded, the market did it for us, right? Otherwise, we do it ourselves. We know what the fair market value is based on what the interest rate is, right? Compared to current interest rates. So I can get the fair market value of this one. Guess what? If I can get the fair market value of this and this, I can add those two together and I know this one. What's the problem I have? I have no idea what assets to allocate the value to. Most of the change is goodwill. My reputation's growing, my customer base is growing, my relationships with my employees are growing, getting better. I don't know. Got it? And if the fair market value of the liabilities plus the fair market value of the equity are less than the book value of the assets, I do know I have a problem. And we need to write them down. Right? I'm in trouble. And then we have to figure out what should be written down.
Can you also find out how much your company is worth at a particular point in time?
All you do is you look it up. I'm not kidding.
Yeah.
But it's not really valuable.
What?
It's better than nothing. I mean, you can go see what the stock's selling for. That's what it's selling for. That's what everybody thought it was worth. I can tell you right now, well, we can tell you at the close of business today what Young Brands was selling for. We can tell you how many shares they had. Multiply the two together, it's what it's worth. That day. What's the problem? Tomorrow it's worth something else. Right? Stock price changes, number of shares change. Worth something else. Constantly moving, right? What happens when there's a 50% drop in the market like we had about 8 years ago? Or George Bush, right? Into his presidency. It was, right? Obama's a hero because now the market's 3 times what it was. Nah, no, it's not. I don't think George caused it to fall. I don't think Obama caused it to rise. Some maybe their policies have some impact on it. I think massive fraud caused it to go down. Subprime loans, yeah. Right? There were a whole bunch of loans that should not have been made, and then they were turned into investments that weren't real investments. They got a rating, so yeah, it's fraud. Nobody knew who stole what, who got what. You know what's so sad about that? Is I might have become richer because of that fraud. I have investments out there. I didn't intentionally buy anything. It was investing in subprime stuff, right? Taking winnings out of it. But I bet I got some. So I don't know if I got hurt or got helped. Wow. Long term. That's awful, isn't it? Our economies get real complex. Can't even tell what's going on. It's really something. And economists are studying it all the time, right? Finance people, researchers. Okay, anyway. So that answer your question though? Why don't we put them in market value? We don't know what they are. If you own a house, you buy a house for $200,000,
Yeah.
and you bought it 10 years ago, what's it worth? Who knows? Unless you do what?
It's worth the market value of the land.
It's worth the market value, but how are you going to find out the market value? Sell it. If you don't sell it, you don't know what it's worth. My wife and I bought a house 10 years ago for $170,000. I hereby decree it's now worth $1.7 million. I think I'll put that on my balance sheet. Prove me wrong.
Yeah, okay, now
I have to sell it.
you can go to the real estate agent.
Oh, no. Those are appraisals. There are all kinds of appraisers you can hire, and they'll say, well, what do you want it to be worth? That was one of the things that happened at Fiasco with all the loans too. Appraisers were saying the property was worth whatever the loan was going to be, plus the down payment. Everything was worth what you were paying for it, no matter what you were paying for it. No, it's not. Well, I guess it is if you paid that for it. The reality is, okay, the two of you walk in and you're going to buy a brand new Mustang, right? What does a Mustang cost? 30 grand? I think you get a pretty nice one for 30 grand. Yeah, you can't get the real nice ones that are 40 or 50. But you can, I guess they're real nice. Not like that. But anyway, not to me. $30,000, right? Skipper says 30. She's a good negotiator. You're not. You go in and you pay 30. She goes in and pays 27. You know what the fair market value of yours was? 30. You know what the fair market value of hers was? 27. Exact same car.
So what's the time?
Now, when you drive them off the lot, what's the fair market value? I don't know. Turn around. Drive around the block and go back in and try to sell it. She might get 22, right? She might only lose 5. You're going to get 22 also. They're going to lose 8. But we don't know how much they're going to get unless they do what, guys? Go around the block and go back in and try to sell it. Got it? Got it? Because they're going to keep their profit when you sell it back. And then they're going to make sure they have a profit on that used car, too. So they're not even going to give you, value that way. Okay? We don't know what anything's worth unless we sell it. That's the mess. That's the argument for the historical cost. You guys buy that argument? You don't have to. It's theory, right? Should we value everything at market value? Yes. Do we know the market values? No. So what are we doing? Faithful representation, right? Telling the truth compared to what? Relevance. What's more relevant? Historical cost or fair market value? Fair market value. What is more reliable? What is more faithful representation? What's more verifiable? Historical cost. Why do we use historical cost? At least it's stable, right? It's not your job as the accountant to tell people what things are worth. It's the job of the people investing in the company to guess what it's worth based on the information we do give them. It's true. If they want, I can tell them what the fair market value is of the stock. Fine, big deal. They don't need a financial statement for that, right? And it's not particularly useful. How do we know if a company's overvalued? If at a point in time the market cap is real high and then it goes down, we know if it's overvalued. How do we know it's undervalued? If the market cap at a point in time is some number, it goes up later, it was undervalued. This is one Will Rogers had. I love this thing. You guys know who Will Rogers was? Sort of a folksy poet, writer. He writes funny things. And he's really clever. Made commentaries on society. And you should read some of his stuff. He's really very good. Anyway, Will Rogers had a thing, not just entertaining, meaningful too. But anyway, Will Rogers had a thing on how to make sure you make money in the stock market. Buy a good stock. Wait for it to go up and sell it. Take your gain. If it don't go up, don't buy it. You guys finance types, that's what you're going to do in your careers. Don't buy the ones that aren't going to go up, only buy the ones that are going to go up. And have that for your clients too, and you'll get real rich. How do you know which ones are going to go up? Beats me. If I knew that, would I tell you people? Of course not. I'd capture all the wealth in the world. Right? I know what's going up. You don't. I'm going to place bets. I'm going to always win, and I'm going to have all the money. You know what Warren Buffett says? You know who he is, right? Extremely wealthy guy that invests. Big philanthropist, too. He thinks doing the right thing is profitable. But anyway, what he says is it's a really boring strategy. He says what you do is you buy really good companies, and as long as it stays a really good company, you just keep the stock forever. and if it ceases to be a good company, you know, management changes or they do something gets screwed up in the company, what do? Sell it. Do you ever sell it if it doesn't cease to be a good company? Why would anybody in their right mind do that? You give us one of the future cash flows, which is a thought. Boring. The other thing I really like about his, one of his things he said was, Simon at a talk show one time, and he says, he hasn't known for years whether or not he makes any good investments. Because every time he invests in something, everybody else buys it too because he bought it. And it goes up. He can't lose. So he gives most of it away. And it continues. So wouldn't that be a nice position to be in? You know, and he doesn't know whether he really made good decisions like everybody else. He doesn't know whether he made really good decisions or he just got lucky time after time after time. Probabilities, you guys did statistics, right? There's a certain probability that every time, you know, if you flip a fair coin, would you get a string of heads with a fair coin? Sometimes. String of tails? Sometimes. Could you make investments like that? If you had time after time after time, even though you didn't make a particularly good investment? Well, I guess you did with hindsight, right? They all went up. You must have made good ones. But could it be just chances to your skill? Yeah. I don't know. It's like who wins the Super Bowl? Is it the most talented team always? I don't know. I guess that moment, that day. Yeah. Anyway. If you hit, you hit. Okay, what else can we talk about? Oh, intangible assets. How do you value those? Typically at what? Historical cost. Amortized historical cost is one that amortizes copyrights or something over its life, right? Happens. What about goodwill? It's the discounted present value of all the future cash flows you're going to get out of that goodwill investment. Or what? Historical cost. We leave it at its historical cost unless the discounted present value of the future cash flows out of that is less, and then we're conservative when we write it down. There have been massive goodwill write-downs. One company buys another company. Everybody wants to combine companies, right? Consolidate, right? And what happens? A whole bunch of people want to buy the same company. What tends to happen? I hope it's happening with Humana for all the Humana shareholders because they're being bought up by somebody. There's only going to be 3 health insurance companies in the nation now because there were 5. 2 of them are being bought by somebody else. Humana's being bought currently, right? They're trying to buy. Let's see whether or not the federal government lets the deal go through because of antitrust laws. Okay? Forces actually. But anyway, is it a good deal or a bad deal for Humana shareholders? Probably a good deal. Why? Because people are bidding and driving the price up. They might pay more than they should. But then if you pay more than you should, you'll have well, if you pay more than the fair market value of the assets, less the fair market value of the liabilities, what do you have? More than the fair market value of the equity, so you bought goodwill, right? We'll record that as goodwill. And the AOL Time Warner deal, the shareholders of Time Warner gave a whole bunch of money to the former shareholders of AOL, and then they found out AOL was pretty much worthless. America Online, you ever heard of them? They used to be the biggest internet company. Now they're nothing. So the shareholders of Time Warner lost a fortune. Gave it to the company's shareholders that they bought out, right? What do they have to do with all that goodwill? Write it down. It's a massive write-up. You'll look at that with Richard Schrader in 414. Yeah. If he likes that stuff. Okay. So anyway, enough on that stuff. Liabilities, how are they? They're usually at what? Historical cost. But you know what? If it's a current asset or a current liability, is historical cost okay? Accounts receivable. Should they really be discounted? Accounts payable, should they really be discounted? I guess probably, right? Because $1 a month from now is not quite the same as $1 now. But what would we say? We leave them at historical cost because the difference between the discounted present value of what we're going to pay on a payable or the discounted present value of a receivable we're going to receive, right? The difference is what? What's a good word that we like to use for not having to do anything? Materiality. It's immaterial. We think it's immaterial. If it's a very long period of time and and the cost of capital is very high, the interest rate is very high, what should we really do? If I give you 2 years to pay the debt, what should I do? Probably discount that back to now, right? Because some of it's interest, and you know what? We'll do that. When we sell things with a note receivable with no interest involved, we will impute the interest, we'll discount, okay? So if it's a long-term one, and it's material, it'll probably be discounted present value of those cash flows for debt or equity. Or I'm sorry, debt, well, equity too. But if it's debt or if it's an asset, either one, right? No receivable or no payable, right? But if it's real short term, what do we probably do? Leave it at historical cost. Make sense? Okay, so all the current assets and current liabilities typically at historical cost, except for, I take that back. Accounts receivable is not really at its historical cost because we take away the allowance. So what do we say? It's at net realizable value. What do we mean by realizable? Cash. So it's accounts receivable less the allowance. It's how much cash you're going to get. So we have receivables at net realizable value, we say. Inventories at lower cost of market, buy for life. Okay, good. All right. So it might be at historical cost unless market's lower. Okay. Liabilities, we put in order liquidity too. They show a nice example for Halliburton. Okay. You guys can know about liabilities are going to be satisfied by delivering goods or services. What are those called? I just gave you a definition of what? Well, that's not revenue. It's a liability. So keep going. It's a liability that's going to be satisfied by delivering goods or services. Probably means they paid me in advance. What do I have? Unearned revenue. It's unearned revenue, right? It's going to be revenue you can earn. Yeah, absolutely. It's your right tax thing. Okay, all right. I'm sure liabilities, all kinds of stuff. Bonds are going to be what? They're really historical costs. Plus or minus the unamortized discount, right? Okay, so amortized value. And then show some disclosures for notes on page 225. Good, great. The long-term portion, the short-term portion of the debt, long-term portion of the debt. There's a note that shows what the interest rates are when they're due. Take a look at all this stuff. Okay, less the current portion. Okay. Owner's equity, and probably pretty much self-explanatory. We pounded through a lot of it. Oh, we had the non-controlling interest in the income statement, didn't we? Their share of the income. The non-controlling interest, that's of the subsidiaries, right? When you do consolidation. What's this non-controlling interest, minority interest? That's the minority shareholder share. What kind of account is that, minority interest? Kind of hard to tell, isn't it? Is it a liability? Do you owe them anything? No. Is it equity? Do they have any real ownership share? Not really. It's the ownership that doesn't have a vote, right? Basically. So what we do is we list all of the liabilities, get total liabilities. Then we'll put minority interest in the middle, and then we'll list the equity separately and get total equity. And then we add together the liabilities, minority share, and equity to get the total liabilities and equity. Got the idea? Kind of a quasi-liability, except I'm not going to pay it. Quasi-equity, except they don't have a vote. Make sense? I guess it's more equity because it's their equity interest in the total company. But they don't have a vote. They do vote, of course, but they don't have any real say because they're minority shareholders. Okay. They're minority shareholders in the subsidiary. When you put all the companies together, now how much vote do they have? Wow, tiny, huh? Do you have 100 companies you put together, or 150 or something? Okay. They give you a bunch of stuff. Page 227. Could you prepare a balance sheet that looks like that one? Did I give you a problem? I bet I haven't. This is something shattered. I probably wouldn't have done that check history. But the really neat problem they do on the CPA exam a lot is they'll give you a balance sheet or an income statement or a cash flow statement. And there'll be mistakes in it. And then they ask you to do what? Tell us what's wrong. Right? Have I done that with you guys yet? I haven't done it. What would be a good approach for this? So I gave you a balance sheet with just all that stuff. Count names wrong, liabilities are classified as assets. You got the idea. Current stuff is classified as non-current for assets and liabilities. Some of the equity, you throw dividends up under assets or something, and it's really, of course, reduction, repatriation. So I give you this screwy statement and ask you to fix it. Not to fix it, I ask you what's wrong. So you're going to give me a list, 1, 2, 3, 4, a whole bunch, right? Usually I can find more than the authors suggested for the CPA exam question. There's usually more than they even tell you about, right? You just keep thinking about it and find it, right? So relax, use your imagination. What is in the wrong place? What should this be? But here's an idea for you. If you get one of these on the CPA exam particularly, they're going to probably give you quite a bit of time on a problem like this, right? I have an hour to mess with. I'll give you a fair amount of time. It'll be on the take-home exam probably when you do the exams. If I do on the quiz, you obviously have to move quicker, right? But here's what you could do. You could write a perfect statement. You could take the one that's messed up, put it in perfect form. And then what you could do is just put a number next to each thing you changed on it, and then write a little explanation. Tell you what, on the CPA exam, if you put the perfect statement next to the wrong one, all they do is look at it and see it's perfect. 10 out of 10, right? You get 10 points out of your 75. Just boom, right? Versus if you try to write it down and you tell everything that's wrong with it and you go on through, you know, will you really pick up everything or will you screw something up? I bet you screw something up, huh? And even if you don't discuss the things you changed, all of them, if you don't get to it, you changed them all. It's pretty obvious you knew what was wrong, right? And you can fix it. Now, don't just do the statement. If they ask you to discuss, what does that mean? By the way, but I've given you guys some questions that said discuss, and some of you have given me a list, haven't you? Knock it off. I was pretty lenient, right, on this test. What did I ask? I asked what was better about the FASB than the APB, right? And I wanted 5 things because there were 5 points, right? So there were 5 things. Some of you were a couple of you were fairly close to just listing the 5 things, just the terms. But it said in the question, discuss, be careful. Discuss if they ask you to discuss. So what would you do? Write the 5 terms down, put a dash, and say what it means after each one, real quickly, which most of you did. Be sure and do that, okay? Right? And I'm not telling you just for my test, do that on the CPA exam. If they ask for a list, do a list. Right? If they ask for discuss, they're giving you an opportunity. You could screw up something on your list and tell them the right thing in your discussion, you'll still get part of the credit, won't you? Get the idea? Okay. If they want a list, they'd probably do a fill-in. Okay, well, so you have a question? There's an awful lot in here, isn't there? Taking a look at that statement there, that balance sheet, do you guys have anything that kind of, notes their inventories are at average cost, I should say lower cost or market average? And do you get the idea there's a lot of flexibility here? Yeah.
Why would they write land at cost? Isn't it already a cost?
Yeah, you don't have to say land at cost. The land would be at cost, buildings would also be at cost. I guess I just want to reinforce for you, but I'd never put that on a statement. I just say land and buildings, it's a cost. By the way, when you do your notes of the financial statements, the first note is going to be a summary of significant accounting policies. Significant accounting policies, right? It can either be not numbered or it can be note number 1. That's always the first one, right? And if you don't number it, the next one's note number 1. Big deal. Okay? In that summary of significant accounting policies, you'll list all of the choices you made when they're a competing gap. So in there, you would say that you're using LIFO, right, or FIFO, what method you're using for depreciation, straight line or declining balance of some kind, those sorts of things. Usually, there won't be any numbers in those notes. The notes where you put the numbers are the ones that are numbered, 1, 2, 3, 4, or 2, 3, 4, whatever, okay? Where you put all the detail of, say, depreciation, you might show how you calculate depreciation numerically, that sort of thing, okay? So typically that's done, and it's not followed 100%, but typically that's the idea. So you need to know what a summary of significant accounting policies is, and they talk about that, right? And then all the other notes are really probably more number-oriented. That make sense? If there is no choice in terms of what you do with GAAP, like land is the historical cost, you don't have to say that land is the historical cost, because everybody has land as historical cost. It's just where there's a choice. Does that make sense? Or if you do something different than everybody else does, you definitely need to say it. What if your financial statements are cash basis instead of accrual basis? I would put on the face of each statement that they're cash basis. Wouldn't you? I wouldn't call it a balance sheet. I'd call it a statement of assets and liabilities or something, right? Okay? And then some other name. So they don't think it's accrual basis. Then I'd say cash basis. And then on my income statement, I wouldn't call it an income statement. I'd call it a statement of cash receipts and disbursements or something. Does that make sense? And call it cash basis. So there's an example. Then in the notes to the financial statements, I'd have a note that describes the difference between accrual and cash basis. Make sense? So whatever you're presented with in the statements is what you're going to have to disclose. So this isn't like you memorize everything. It's more like know what you're doing. Okay? For now, I know it's tough. You just kind of have to memorize as you go. Under stockholders' equity, you put the paid-in capital first, right? That's what? Common stock, preferred stock, additional paid-in capital in both. There'll be a variety of accounts, right? Retained earnings that is in there, accumulated other comprehensive incomes in there. Notice what they do with treasury stock. Real common thing you see is they'll put the treasury stock as an asset. You bought your own stock back. That's what treasury stock is, right? I went and bought my own stock. Is that an investment? Of course not. I bought myself. It's retired stock.
Well, with the company, you know.
A company might buy back their own stock because they think their stock is selling for too low a price. If the market doesn't realize how valuable it is, so they buy some of it themselves at the current value to try to get people buying it. There's a little tiny bit of evidence that works sometimes. Mostly not. A more common thing might be that they have excess cash and they want to buy shareholders out. So instead of investing more in assets, they just reduce the size of the company effectively by buying out any shareholders who want to sell. Well, you go out in the market and buy your own stocks, so you eliminate those shareholders, right? The remaining shareholders each have a slightly larger percentage ownership, don't they? So you could do that for that reason. Another reason is you might buy it back from people who are doing hostile takeovers. It's called a green ban. Somebody's trying to buy up your company and have control over it, and your management, and you don't like that, and you can convince the board of directors, right, represent the shareholders, to buy out that shark that is trying to take over your business. There's some ethical issues with that. Because what are you doing when you buy it out for them? They buy it, say, at $100 a share, and you buy it back from them at $180 a share. You're giving them a huge profit. And whose pocket are you taking out of? The existing investors. So the shareholders might have been better off with the takeover people buying up the company, right? Instead of you buying them out to protect your job. So this is a really contentious area, right? Of whether somebody trying to take over, a hostile takeover, somebody trying to take over a business is good or bad, right? Is it good for the economy, bad for the economy? Is it good for the shareholders, bad for the shareholders? Well, if they drive up the price of the stock and you make a whole lot of money, and you get out of the business and you have your money, and now they have it, who cares if they have it? I got my money, right? Might be good for me. The management might lose their job, but that's kind of their problem, right? They should have done a better job running the company, made more money for me. Because I made more money by selling my stock to the takeover artists, right? Got the idea? So, yeah, so that's true. There's that too. So we go through these phases of companies buying up other businesses, and then they're combining the businesses. So a whole bunch of takeovers of their businesses that way, one company buying another. And then we go through phases of companies buying their own stock and buying a whole bunch of treasury stock. It's kind of cool to watch.
I know that.
Sometimes it doesn't seem very logical. So a question here in the back.
I was just going to say, so that guy who was like purchasing like Sunco and dumping everything, is that like a hostile takeover?
Yeah. Mm-hmm. Yeah. And you have to report, you have to do an 8K. You guys know what one is, right?
Like special events?
Yeah, special events, major things that happen. So when you get to a certain point of ownership, you have to disclose to the SEC. It's sort of the same thing. You have to tell the SEC how many shares you own, what percentage you own. And then the company knows you own it. And then they know about you. Right? So when you hit a certain point, you have to disclose it. Yeah, to keep it from being really totally secret. Then they can start taking actions to try to get rid of you. One of them is to buy the stock. Another one's a poison pill. They can write agreements with other companies that would just be disastrous if the takeover happens. It would make their stock go way down in value. Ethical issues of that. Another one is you could do scorched, which means you go out and borrow a whole bunch of money, so now you're not a very good company, right? Again, so way you get credit for yourself. One that's interesting is Brown-Forman. They have Class A and Class B stock. If you want to buy Brown-Forman stock, you can, but it's all Class B. I own some in mutual funds. Good stock. I hold out of some. They do really well. Brown-Forman, you know what they do, right? I'm one of their major customers. Yeah. They make bourbon and whiskey, other spirits, so they're alcohol. But anyway, they're not my favorites actually. But they send them from students here, so I like that a lot. Not my favorite bourbon. But anyway, they have Class A and Class B stock. Class A is only owned by family members, descendants. Class B can be owned by anybody, but guess what? versus selling their stock. It'd be really, really tough to take it over. Most companies are not that way. If you buy 50% of the stock, you own it, right? You're in charge. Now you can close them down, sell off their assets, merge them into your business. So all this stuff is important disclosure, isn't it? Yeah.
Is that kind of like preferred stock then? And they don't.
It's kind of like preferred stock, only it's not preferred stock.
Right.
Preferred stock usually doesn't have a vote.
But
Well, it's kind of like a preferred stock, except I see what you mean. It's preferred stock in that it doesn't vote, but they share in the earnings. They're sharing the risk and they're sharing in earnings. Preferred stock usually gets a preferred dividend, that's all.
Right.
Preferred stock is closer to debt, probably. Right, sort of in between debt and equity. And we'll talk about that stuff as we go along too. Not in this class, but later. We'll talk about preferred versus common stuff. Yeah. You guys start, you start to get the idea that this is an awful lot more than debits and credits. Goes into this. There's a reason we get paid money, you guys. It's not just no left and right, really. Right? Although if you don't know that, you're in trouble. I have a real problem. Yeah, okay. Another one back to that.
So does buying your own stock make your financial statements look good?
No, there's absolutely nothing to it. It's credit cash and debit treasury stock, and treasury stock reduces your equity. It goes down where? Where is it, guys? Did you know that? Where is it?
The last thing in equity, right? The very last thing, before any non-controlling interest there, right? Way down at the bottom.
Reduction of retained earnings, basically. Right? Oh, by the way, you can also retire that stock. You don't have to reissue it. Treasury stock, you could resell it. Remember in principles we did that? You don't have gains and losses, do you? I know it's an economic gain or loss, but it's not a gain or loss. What is it? It's more additional paid in capital. They pay more than you paid for it, right, when you reissue, right? If you had a economic profit on it, it's additional paid in capital. You can't have gains and losses in your own stock, right? And if you sell it at an economic loss, what happens? You get rid of any additional paid in capital from treasury stock you have. And then once that's gone, where does it go? Reduction of retained earnings, right? Remember that stuff? He's looking at me like, God, I hate you. It'll come back. You didn't even learn it very well the first time, did you?
No.
Yeah, so that's even better. Yeah, you're getting there. Did I give somebody a principles book? Did I give you one? I have another principles book downstairs if you want. And when you're reading this stuff, it'd be really useful to go back. I just got it back from a principal student who decided not to do principles. And I had loaned it to him until his book came out. But I've got one downstairs in the morning if you want to stop by.
Sure.
Yeah.
Thanks.
Yeah, I was going to ask you, what's the difference between debt and equity investment?
Debt and equity investment. Oh, an investment in debt is I bought a bond. I invested. It's still an investment. It's an investment in other companies' bonds, right? You know, or investment in any kind of debt security. Right? I bought the debt security. Okay, an investment in equity is I bought their stock, preferred stock, their common stock. Great question. Nothing wrong with that. There's a lot to get out of this, isn't there, guys? When you read it, you have to step back, read a sentence, step back, and think, what is that thing? What is that thing? Are you getting this so you can read it and kind of know it better than when you were first doing this class? Because at first what you guys did was you read and you didn't know the damn thing, am I right? Just going to in and out, like, oh, Keith will explain everything. No, it won't. There's no way I could explain all that. We'd have to be here for 20 or 30 hours a chapter. Talk about what's in each chapter. Because you need to spend 20 or 30 hours on the chapter, right? You kind of do. It's awful, isn't it? But there's a lot there. But again, you don't want to be here for 5 or 6 or 7 or 8 years, right? 4.5 with a full-time internship would be fantastic. That's good enough. Another question,
Yeah, I was just asking why would you buy a bond? I was like, what makes what makes people do that?
Bonds are less risky than stocks usually, right? They tend to vary in price less than stocks do with ups and downs in the economy in general. So you can get a return out of them that is far better than obviously a savings account or a money market account or something, right? Where you have no risk, right? But you have risk, and what your risk is the price of change, right? Up or down. So it could be positive, could be negative. And what tends to happen what happens to bonds as interest rates go up? The bond rate does not change, the interest rate goes up in the market, what happens to that value of that bond? It goes down, right? Because nobody likes that interest rate. Remember on discounting bonds, right? What happens if interest rates go down and the bond rate doesn't change, of course? It does not change. Now it increases in value. So you could have gains or losses on bonds, just like stocks, but they tend to move less.
Right.
That makes sense? Yeah. And as interest rates are changing, you might be better off with bonds than you might be in the stock market is the idea. I don't fully like it, but that's the idea, okay? So we're getting really into finance now. Yeah, absolutely. Okay, so where does the accounting stop? Finance starts now. It's all kind of perhaps. If you don't understand the accounting, you'll never get to understand the finance. And if you don't understand the finance, you're not very valuable as an accountant. Makes a great double major. If you don't double major, which is fine, of course, and you have to like number crunching to do the double major of that. But if you don't double major in that or you're a certificate or something, what do? Learn as much as you can about finance as you go forward. Right? It's okay. It doesn't make any difference. I didn't have a finance degree. I know a lot about finance. I did a PhD in accounting, which was a lot of finance. So, but not real finance, theoretically. It's not stuff that you got in the marketplace. I still don't know a lot about how markets work. Cash flows, we did do the cash flow. There is one out there, right? Online? Right? I am running out of time. There is one on Moodle that you can watch, and I'll put the problem out online, and you can look at the problem while you listen to Moodle. Okay, that would be a nice idea. I don't really like the coverage we did of cash flow here very well. I think it was a lot better what we did in principle. You know what's really good? Do you still have your Accounting 102 book? Garrison? Anybody have their Garrison book still? You did keep your books, didn't you? Accounting 101 and Accounting 102 books?
Yeah.
Okay, Garrison you had for Accounting 102, that book. The chapter that you didn't cover in that class, because we do it in 101, because it fits there better, okay? That's where I got those problems. So if you've got your Accounting 102 book, that Garrison book, find the chapter on cash flows and skim through that and look at their examples. They really do a great job. I'd really rather use that for principles than what's done in the Accounting 101 book. Right? That's why I use the problems from Garrison. Okay, so you could look at their example. That would be a good way to do it. Look at their example would be faster than listening to my video and cranking through it, looking at it. Okay, makes sense. Because we're doing this on Wednesday. So everybody, how many have their Garrison book? Only one, two?
Mine was online.
Yours was online and now it's gone. Yeah.
I don't know if it's gone. I probably log into it still.
Oh, well, if you can do. Yeah, that's the trouble with online books. Don't do that anymore.
That's what it's
All of them are online?
Yeah.
And you don't get to own it forever?
I mean, you could go out and buy it yourself, but that's what you do to the bookstore.
Yeah, okay. Yeah. Anyway, I like everything online, don't get me wrong. But I want to have it forever. You want this book forever. Everybody does have a copy of this book, don't you? And yours isn't loosely like mine. Yours is a real book. You're going to put it on your bookshelf. And people are going to make fun of you at work, right? When you start working, they'll, for God's sake, you have your intermediate book. And then they'll ask you a question and you'll pull it off the shelf. Right? Look it up. All it's going to do is tell you where you should go look for the real answer, right? These are really brief descriptions of what's in the passages. This is just the APBs and the passages you got here, you guys. Right? And they're really brief, condensed, watered down. Okay? You can find all kinds of stuff in the real passage. But what will this do for you? Oh, it'll give you an explanation. You can look, oh, that's what that was. Now I remember. I know how to do leases. I know how to do pensions, whatever it is. Something that's complex. And then it'll tell you which APB or which strategy you should go look at. And you're stuck, right? You're away. So don't ever throw away this book. None of that. By the time you should throw it away, it's totally obsolete. Right? There'll be several versions after that. Okay? So this, I know I'm beating you up on this stuff, but it's really important. Fair values. How could you get the fair value of something? What are the ways you could do fair value? What do you think, guys? What do they suggest for you to get fair values of something? Fair value. Look at level 1, 2, and 3 down there on page 238. The hierarchy has 3 levels. Level 1, the least subjective, is based on observable inputs. I want to know what GE is selling for, right? I can go look up the stock. I own 1,000 shares of GE. What's market value? It's 1,000 times the fair market value the last day of the year. Got it? I go look it up. I know exactly what its fair market value was. That's the best. Level 2 measures becomes more subjective, are based on market-based inputs other than those in level 1, such as market prices of similar assets, right? Okay? For real estate, it would be a comp, right? There's a comparable, right? If I really wanted to know what my house was worth, I'd have to find houses that are comparable to it in the real estate market. But there's nothing exactly like it, is there? There isn't. Same block. I could maybe find some in the neighborhood that are similar, but they're not quite the same. You know what I mean? They're different sizes and they're different ages and they're some upgrades. And it's really hard, right? But that's better than just out of the air, my 1.7 million, right? You know, it's better than that. Okay, at least I get in a range if I had some comps. You can do the same thing with investments. You can find an investment that's real similar. So maybe you're a real small company, right? But there are companies that are in the same business. What's their stock selling for? You know, and how similar you are to them. Okay, another comment, question?
Oh yeah, I'm just having a really difficult time like wrapping my head around level 1, 2, and 3.
It's really tough. Really, level 1 is there a published market price for your assets? Level 2 is, are there comparable investments where you can do it? It's a bond, right? You've got a bond, but you own 100% of the bond from some company. So other companies in the same industry that are about the same risk level, they should probably pay about the same interest rate. So you could use their discount rate to discount your bond, you know, and get a value for yours, because there's no market value for it, but you can compute it. Does that help? So can you get a really kind of mathematically based, scientific sort of estimate, right? So it's more subjective than going and looking up a market value, where there's a publicly traded market for it, right? I know what a bond, you know, a GE bond of a particular type, right? I know what that bond is selling for. So I own some of that. I know exactly what it's worth. Right? But it's closely held company. It's not publicly traded. Same with stocks. Level 3 measures most subjective, unobservable inputs of company's own data or assumptions. Be careful with that one. But you know, if you have to use fair market value, you know, it's an available for sale security. We own all the stocks. Got the idea? Yeah. So better just if you consolidate that problem. All right. I already talked about parenthetical disclosure, right, guys? I talked about the notes before. Cross-referencing and contra items. You know what contras are? I think you're sort of there. Are these ratios fair game for me? Well, of course they are. And then the financial statements, look at them. Don't memorize them, but look at them. There's a nice financial statement there. Procter & Gamble. It starts on page 247. It's a real financial statement. Of course, you could look at anybody's financial statement online, right? You can go look at mine. Okay? So go away and work. Excellent job on the test, you guys. I was impressed. It scared the hell out of me with your quizzes, but that was nice. Evidence of a lot of study. That was excellent. By the way, a C+ in this class is an excellent grade. Right? It is. It's not, obviously you want an A if you get it. But a C+, lots of people that are CPAs out there got a C+. Okay? So don't get disheartened if you get a C+. Work a little harder, right? If you're in a below C category, we can talk, right? Fix it. This is really hard. This thing. Welcome to intermediate. That's all that. You told me to.
Yeah.
Is there a clear third?
Third, or Wednesday, yeah.
That's the one you drop. You take your thoughts.
Yeah.
That's what you do. Okay.
Alright, so I'll be back Monday.
Thank you for letting me know. Very professional. My wife
start running off with some third wings or and go to the
Yeah,
library.
I probably will be around my office. Yeah,
Okay.
that's cool.
That's what I did last time. I'm gonna always like to run it by you just so
No, that's
no
Yeah,
miscommunication.
and if I'm not there, I'll be here.
Okay.
You know, or ask the secretary to show.
Okay.
If I'm doing something different.
Okay.
Or you can call me, I always have
Yeah,
my cell phone in my
I
pocket.
think so. I have it on the
Yeah,
syllabus.
so good. But I'll try to remember which is that way. That's so much easier. Yeah, that's
Yeah, I was just gonna answer your question on non-controlling and controlling.
Yes.
What is non-controlling interest? I couldn't really.
Oh, a non-controlling interest is where I have investments in other companies where I don't own the majority. That's all it is.
Oh, okay.
That's
That's what I thought it
And a
was.
controlling interest is where I own more than 50%. Usually with controlling, we need consolidate.
Consolidate.
And then you end up with a minority interest if you're out.
Okay.
If I have non-controlling interest, I'll either use the equity method on it, right, that's between 20 to 50%, or I'll invest in affiliate of the balance sheet.
Okay.
If I own less than 20%, it'll either be available to sell short-term, long-term, right? Long-term, if it's a very big one, of course, right? Short-term, if it's a small investment for a short period, less than a year, right?
Okay.
Or trading securities.
All right. Yeah.
That's all it is. That's all it is. Yeah, the terminology kind of switches.
Right.
I should.
All right.
Yeah.
Thank you.
Cool. Sir? Yes. This plus your quizzes. So this plus your quizzes. This plus your quizzes is this out of 150. 90. That's where you're at. 55 is the C plus. 50 is the C. So you're at very high C. You gotta do better. No, it's a C. Yeah. Right. It would just be C if I were here right now. You gotta do better at your quizzes. You blow them up.
Yeah.
You gotta study your quizzes too.
Well, I think I did well.
You did really well on this, and then you kind of fell apart. You gotta look at what you're doing. I don't think you're doing as well as you thought you did. Well, the first one was right, the little essay. You didn't do 101. Question 101.
Yeah. I forgot.
Yeah, so that cost you
I
5.
just saw it and I know why I did it.
Oh, you probably got doing it ran out of time. That's okay. You gotta look.
I don't know. What did I do?
This is out of 3.
I don't understand. I thought I got all this.
Go back and
I
look.
don't know why what I did on this thing. I don't know what I did on this thing.
They will not set up for balance sheet for all their 350. Do it. I don't think you use more time than anybody else for any of that, but make sure you do.
Are you going to your office now, or?
Oh, yeah, I'm going over there anyway, if you wanna go on. I'm finally done for the day. This is straight through. Since, 11 o'clock this morning. Yeah. Yeah, it's a long time to be talking to people.
This quiz about half questions and half problems, or we say?
I haven't written them. I'll just grab a bunch of questions and throw them together. Oh, I gotta do this, I'm sorry.
That's fine.
I should have stopped that a while